Lyft reported quarterly financial results on November 6, 2024 that impressed stock market investors. The ride-sharing company is hitting record numbers across all its critical metrics. In this video, I'm going to review the company's latest results, highlight the big picture items that investors need to know about the company's latest performance, and also update my buy recommendation of Lyft stock. Coming into this quarterly financial update, I did have Lyft stock rated as a buy. I've had the stock rated as a buy all year long, and I'm going to update that recommendation here and let you know if I still think the stock is a buy at current valuations. So let's take a look. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. Lyft reported gross bookings in the third quarter of $4.1 billion, and that was up by 16% year over year. Gross bookings calculates the amount of money riders spend on the platform. This isn't the amount of revenue that the company makes. The amount of revenue came in at $1.5 billion, and that was up 32% year over year. As you'll notice, the company's revenue increased by double the amount of gross bookings, and that signals the trend in the industry where ride-sharing companies are taking a greater percentage of the total amount spent on the platform, taking more than the drivers are taking. And that's created a bit of complaints from drivers, but still drivers like the flexibility that working for Lyft and Uber and DoorDash and others provide. You get to choose your own hours. You don't have a supervisor over your neck telling you what to do, when to work, how to work. And so riders continue to choose and drivers continue to choose Lyft as an attractive option. Now, one of the more impressive things about Lyft and the industry overall, Uber included, is the improving cash flow, profitability, and free cash flow across the board. For Lyft, in the latest quarter, cash flow from operations soared to $264 million. That was compared to just $2.3 million in the same quarter last year. For the trailing 12 months, cash flow from operations jumped to $740 million. Huge improvements across the board there. Similar free cash flow numbers, $243 million, up from negative $30 million. For the trailing 12 months, free cash flow of $641 million. And this is coming on the back of increasing scale as more riders and drivers are choosing the platform. The incremental added revenue is flowing to the bottom line, in addition to the increasing take rate, the percentage that the company is keeping for itself. Now, this is a broader trend that's been improving in the industry, is decreasing competition. A couple of years ago, these platforms were fighting with each other, offering better deals, more incentives, more promotions on both sides of the equation, both to drivers and to riders. And that was bringing down industry profitability. If you've been following my channel, if you've read my book, The 6-Step Investing Framework, you'll know that one of the big things I look at is competition. That's one of the 6 steps in my framework. And in this industry, 3 years ago, 4 years ago, competition was fierce and prohibitive. It was causing huge losses on the bottom line. The unit economics were against these companies. Fast forward to today, and those promotions and incentives have eased a lot. They're not as severe as they were. Prices have soared. And so the unit economics are now hugely in favor of these companies. Still, even with those increasing prices, choosing the ride-sharing option like Lyft or Uber is very attractive to many individuals instead of car ownership. If you're working 3 days a week, not that people work 3 days a week, what I mean is going to the office 3 days a week and working from home 2 days a week, which is kind of like the average nowadays, then having a ride-sharing option is a lot more cost effective than owning your own car. You don't have to pay for parking, insurance, monthly payments, interest expenses, all of which is a lot more attractive when you go with these ride-sharing options because car ownership has increased by so much. The price of car ownership has increased by so much. And so it's making these ride-sharing companies a lot more attractive in consumer eyes. And you're seeing that in the results. You're seeing that in the phenomenal increases here. And you could see that with active riders up 24 up to 24.4 million, which is up 9% year over year. The number of rides were up by 16% year over year to 217 million. This is despite the fact that they've increased prices meaningfully in that time. Now, they are making deals for autonomous rides, and I'll talk a little bit more about that later and why it's so important for Lyft and Uber and the industry overall. But in terms of gross bookings, the company expects the fourth quarter to be even better than the third quarter, forecasting 4.3 billion in gross bookings. That will be up from just around 4 billion in the current quarter. And the free cash flow number for 2024, 650 million for the year. Strong numbers for Lyft here. Now, the big overarching risk or opportunity for these ride-sharing companies like Lyft and Uber is autonomous rides. How is that going to impact the business? Now, many industry participants see that as a big risk to the downside, a huge negative for these businesses. I've taken a different approach. I see it as a huge risk, to be sure, but also a huge opportunity, because let me share with you the cost of revenue. For Lyft, in the latest 9 months ended September 30th, they generated $4.2 billion in revenue, and their cost of revenue was $2.46 billion. This is the money that Lyft pays to drivers, $2.4 billion, more than half of its revenue it paid out to drivers. Imagine, instead of paying that money to drivers, Lyft has access to driverless cars. What's that do for the business, right? If you just look at it simply, you say to yourself, okay, instead of paying $2.4 billion, it pays a significantly smaller amount to license the technology from several companies or one company. There's going to be a lot of companies that have this technology, and so you don't have to go to just one. Lyft and Uber might have negotiating power because they are the ones that have the customers to negotiate favorable terms with these autonomous vehicle technologies that are being developed. So what happens to the business, the profitability, if you eliminate that $2.5 billion expense, or you eliminate more than 50% of the company's expense? You can start to see why it's not only a risk for the company, it's also an opportunity. If they're able to harness the technology to improve the unit economics of the business, then it's a big benefit. If, however, whoever develops that driverless car technology skips over Lyft and skips over Uber and doesn't license the technology, or is unwilling to license the technology to them and goes at it themselves, then it could be a risk if they're not able to secure those deals. So it's a big if here. It's a big if on both sides. I don't think it's just one-sided risk to the downside. I think there's also an opportunity here for Lyft and Uber and others in the industry to benefit from the driverless car technology. And you're already seeing them partner with companies like Waymo, right? That's already offering autonomous rides in Los Angeles, in San Francisco, in Phoenix. And next year, they're going to be offering in other cities, including Atlanta. And so if they start to develop these relationships now and grow city by city in the biggest cities, those are the areas with the highest revenue and the highest costs, because the area with the highest revenue is also the area with the highest cost. That's where you're having to pay your drivers. It'll be interesting to see. So following these results, the stock price soared. It's now trading at $17 a share. It's up from $15 a share to start 2024. And it's now trading at a forward price to earnings of 16.5. So to answer the question, do I still think the stock is a buy? I last updated that recommendation on June 7th, and I told investors I thought it was a buy then. And here we are today, November 13th. Following the results, I still think the stock is a buy. In fact, I like Lyft stock more today than I did on June 7th. The company's performance has exceeded my expectations in terms of revenue growth, rider increases, and cash flow increases. So I like the stock more than I did back then. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.